for inviting me. And probably, yes, last year has been very, very volatile for fixed income markets. We've actually seen approximately, I think, yields inching up by around 200 to 300 basis across various economies. You pick up US, you pick up UK, you pick up locally in India. I think the operative rate in India also has moved up from 335 to 6.5. To look across at the entire global cycle, I think what came as a shock was the Russia-Ukraine crisis and the impact of that on commodities, which actually led to significant high inflation. But somewhere down the line, when we look across at things currently and we analyze the macro, we believe so a large part of the front loading of rate hikes is behind us. Incrementally from here on, we don't perceive any significant rate increases. In fact, our view is when it comes to Fed, I think the two rate hikes are already priced in. The two future rate hikes are already being priced in across the curve. If you look at the Fed futures, they are pricing in 5-quarter kind of a terminal Fed rate at this point of time. When it comes to Indian markets also, I think a 6.5 to 6.75 kind of terminal repo rate in this cycle is already been priced in. Looking at the macros, and probably if you have seen, and I'm sure you must have all read through and heard governor speaking after the MPC policy, where they mentioned that the next year inflation projections, specifically for India, probably looks around 5.3, 5.5 band. The Q4 2024 inflation is close to 5.5. With a 6.5 kind of an operative rate, 100 basis of real rate already being there, we believe that the incrementally from here on, the bar for rate hikes now looks very, very high. We believe that at max we can see another one more rate hike, but I think significantly above 6.75 we don't see the operative rate to go above. So our view is a large part of the global uncertainty on rate cycle is behind us. Peak of inflation everywhere, be it developed markets, even locally, we have seen the peak, and incrementally from here on, the next 6-9 months prints will be on a downward trend. Growth looks comfortable, and hence from here on, I think for a large part of 2023, we would be on a stable rate regime, specifically in India. See, always on the fixed income side, I think there are three drivers or levers of generating alpha in fixed income markets. That is one, the interest rate cycle, which is all about the interest rate rise or interest rate cuts, and depending on the macro, which is more inflation and growth dominated. The second aspect is to look across at what is the how is the credit cycle. So it is the second lever is credit, and it is very, very positively linked to the economy. I personally believe that economy and credit go hand in hand. The more stronger the growth, the better the credit cycle, and vice versa. And the third lever is the liquidity. The liquidity has been, like, if you actually look across in the last 2 years, where central banks infused, not only in India, across the globe, such high liquidity, we've actually seen the short end of the curve massively outperforming. So these are the three levers or the determining factors which always investors should look across at while investing in various fixed income strategies. SEBI has done a beautiful job of classifying categories according to the investment horizon. So if your investment horizon is short-term in nature, pick up the money market or the short-term space, which actually helps you to have a good experience and match your investment horizon. And probably at current levels, where entry levels for anything beyond 6 months are at 7.5, the curve is very, very flat in India. Currently, if you look across at entire point on the curve, which is 6 months to 15 years, I think everything is very, very flat at 7.5. So with these entry levels, just pick up your investment horizon and probably determining currently within a stable rate regime, we believe the short to medium term category makes a lot of sense for investors. So personally, if you ask me, I think liquidity is something which we had seen the best of the liquidity in COVID times. I think in my 15-20 years of career, 8 to 10 trillion of positive banking liquidity, except for demonetization, we have never witnessed. In fact, it would be never ever in India. So I think this kind of liquidity which was there, it was more to avoid any kind of accidents and ensure financial stability in the country. We believe that RBI have taken all the steps, actually moved to almost neutral liquidity, and from here on RBI will keep the liquidity closer to neutral to a bit marginal positive. So is liquidity a driver incrementally for alpha? I think probably no. We would have a tight liquidity environment, and in a tight liquidity environment, generally what we have observed is the curve in the fixed income side is very, very flat. The other two drivers, which are duration and credit, our view on credit is for the near term, we believe that because economic growth is still sanguine, we will see some bit of surprises in the second half. Our view is our internal projections on GDP is slightly lower than RBI's, but economic wise, I think still there is strong demand. India's situation is quite comfortable, and we don't the balance sheets have significantly got delivered. So at this point of time, we would be comfortable, neutral, and positive on the credit cycle. Spreads are also attractive. So from an overall perspective, positive on the credit side. The third aspect, which is duration, I believe so that the inflation mandate for RBI is not. They would not start cutting rates if we are at 5 quarter, because as I explained you, if for the full year also next year, if inflation hovers around 5 quarter with a positive real rate of 125 basis, the repo rate doesn't go beyond 6.5, 6.75, but vice versa, it doesn't significantly fall also below 6.5. So unless and until we see a big growth shock or an inflation significant downtrend where we reach a 4% kind of inflation and we sustain over there, we don't expect RBI to be in a hurry to cut rates. So our understanding is, as I told you, we do a top-down approach on analyzing the growth in the economy and probably linking it with the credit cycle. We are still neutral to positive, I would say, on the growth cycle on a relative basis to the rest of the world. Secondly, when I come across to the overall credit spreads, the credit spreads are okay and attractive. The third aspect is we actually seen a significant deleveraging of balance sheet. The leveraging will happen over the next 2 or 3 years. We've seen a significant cleanup of the NPAs at the banking sector. So our belief is that at this point of time, with all the thrust of the government to spend on infrastructure, with all kind of schemes which they have enhanced, and ensuring credit growth in the economy, we are neutral to positive on the credit cycle. We are okay with the spreads also at which AA and single A assets are getting traded. A well-diversified and I would say a credit fund, which is probably credit fund YTMs are hovering between 8.5 to 9%. At these kind of levels, yes, these funds do make a lot of sense for investors who understand first credit volatility, who understand that they are entering into a fund where in a large exposure is invested into AA and below assets. Definitely, and these investors are okay with understanding the credit risk appetite at these levels on a larger macro environment as well as credit spreads. We do advise clients that they can look at credit funds. Right. So, see, my understanding is what has happened is somewhere down the line, the investor experience in fixed income funds, or investors look at fixed income as more a product which is a substitute to traditional investments, whereby they're looking at capital protection and somewhat of, I would say, near FD kind of returns. What our understanding is that if actually investor catches up on two major important aspects. That is, one, looking at what is his investment horizon and the entry levels are correct. And if the investor matches his investment horizon with the right category of the fund, investor experience in fixed income will be far much more superior. As I told you before, that SEBI has done a very good job of categorizing funds as per the investment horizon and somewhere down the line the risk appetite also. So if investor knows that his investment horizon is only 3 months, probably he should invest only in a liquid fund. Vice versa, if his investment horizon is 3 years, then he should look at something like a short to medium term strategy. And if he has an investment horizon which is as long as 10 years, then why not invest in a long duration fund? The entry level is currently at 7.5 and beyond. As I told you, the entire curve is very, very flat. If you actually match your investment horizon with the category of the fund, I think the overall experience will be very, very good. If the experience of the investor is good, I think the mutual fund on the debt side also will start deepening and we will actually see a lot of participation from the retail side also. I always, if you actually look at the longer term history on asset classes returns, and you actually look across at return gaps between equity and debt over a longer time, over a 25, 30-year period, the actual return gap is not as high as what we see in a year, where we see at times equity as asset class outperforming by 10, 15, 20 odd percent. Over a period of longer term strategies, you actually see the returns quite debt and equity returns are quite competitive, and probably the gap is not even beyond 2-3%. So if an investor that, and I repeat this, if the investor understands the investment horizon, matches the investment horizon with the right category of the fund, and understand that what is his risk profile, is the risk profile is probably matching the duration investment horizon, then I think the overall experience will be quite great. So I am a chartered accountant by profession. I was with PricewaterhouseCoopers, and at that point of time, I used to look at. I've actually been seconded to Toronto and learned a lot about REITs. That excited me about when I came back to India. I got an opportunity with working with a mutual fund, and probably at that point of time, investment was a function which gave me a lot of, I would say, insights on where the economy is, the entire macro part about learning about growth, learning about inflation, learning about the macro environment. That actually gave me a lot of thrill, and that led me to take the decision of entering into fixed income. Obviously, I was lucky enough to get the right leaders into various roles and various organizations, and that helped me for throughout my journey. So my investments are largely with mutual funds only. A large part of it would be with, I would say, more than 75-80% with Axis Mutual Fund. What currently, if I actually look across at the environment, and as I told you, for me, I think the absolute entry levels for fixed income are very, very attractive. Like last 2 years, fixed income returns have been very, very depressed because YTMs of funds after June 2020, when this entire COVID-induced measures got infused into the economy by central bank, I think the absolute levels fell or collapsed, where 2-year, 3-year segment fell below 5%, 1-year assets fell below 4%. So last 2 years has been very, I would say, muted returns for fixed income markets. Incrementally from year on, where the entire curve is priced and very, very attractive at 7.5, a larger portion of today of my savings and investments is into debt funds. Because our government has also done a superb job in continuing with the spending and building the infrastructure. I think if you look at the quality of the budget also, they've actually moved from unproductive uses, and they've actually diverted those spending towards capital expenditure. So a combination of all the measures taken across by government, it gives me a view that growth also will not be too mud. I think growth cycle will muddle around for this year. So looking at the macro, where interest rate cycle has peaked, entry levels of absolute 7.5%, today I have a significantly higher portion towards debt.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.